Okay, good afternoon, guys. So I'm just going to wait for a few more minutes so people can log in, and then we'll talk about the assignment first, okay, before we move on to today's workshop. So before we start, maybe if you have any questions about the assignment, maybe leave it until the end of this talk. So I'll talk about the assignment first, and then hopefully some questions will be answered then. But if you still have any questions, I'm happy to answer after this talk, okay? All right, so in the first few minutes, I just want to talk a little bit about the assignment, which is due next Friday. So I extended the deadline to the 9th of October, which is Friday next week. So in terms of the data, some people have asked me where to get the data for options and futures and forward contracts, sorry. So the forward contracts or the forward rates are a little bit hard to get because they are over-the-counter contracts, so they are private contracts. So there's a question about whether week 5 to week 8 online materials, would it be enough to go through the assignment? The answer is yes. So if you understand options and futures, you'll be, options and forward, sorry, then you'll be able to work through your assignment, okay? Okay, so the forward rates are hard to get, but you can substitute the forward rate with the futures rate of the same maturity. So for example, if you want to forecast the next 6 months from September to March next year, then you can use the futures rate for the same maturity, right? So you can use the futures rate for the March maturity as your forecast of the forward rate, okay? So in theory, they should be identical. In practice, it could be a little bit different, but they should be very close, right? Now, there are two versions of the assignment. One is for the US market and one is for the UK market. So in terms of the Australian USD exchange rate, you can observe it directly in the market. But if you have version 2, which deals with the UK segment, then you have to work out the cross rate between the Australian dollars and the pounds, okay, using these two exchange rates here. In terms of referencing data sources, so in the next few slides, I'm going to show you the data that I downloaded last week for the assignment, and you can use these numbers for your assignment. Just make sure that you cite the sources properly. So in terms of options data, I got it from investing.com, and the futures data are from CME, okay? You are welcome to use your own data sources as well. So if you can find it on FactSet. So FactSet is another data set that provides detailed financial data. If you know how to use it, you can use FactSet as well. Otherwise, you can just use the numbers I provide you in the next slide. But regardless of what you do, just make sure you cite the sources properly. All right. So in terms of options, as I mentioned before, I downloaded this data from investing.com. And that was, I think, Friday last week or so. So what I look at is I'm looking at the exchange rates, Australian over USD options, okay? And these options expire on the 23rd of March, okay? So if you look at options, right, there will be a few different options depending on the strike prices of the option, okay? So here, this is the put options and this is the call option. So you have to determine based on your hedging strategy whether you want to buy a put or a call option, okay? So in terms of the option, the appropriate option to use, I would recommend something in the middle. So if you are going to use this data here, I would recommend using the strike price of 0.71, okay, Australian dollars per USD. So for this particular option, This is the strike price, okay? So if you buy this option, if you buy a call option, you're going to be selling the USD at, you're going to be buying the USD at 0.71 Australian dollars. Sorry, what did I say? So you're going to be buying the, so this is, I think this should be the value of the Australian dollars in the USD. So here you're going to be buying the USD at 0.70, by the Australian dollars at 0.71 USD. In terms of the option premium, so these here are the option premiums, okay? So if you buy the option, this is how much you're going to pay to obtain the option, okay? So strike price is here. And option premium, depending on whether put or call. So the put premium is 0.02 028, and for the call option it is here, okay? So it's 0.02341. For the PAL over USD options, so here is the exchange rate that you can use. So I give you the link here if you want. You can go here to download the option data. But as I mentioned before, you can use this data on this line as well. Okay. So once again, this is the strike price you can use. This is the price or the premium of a put option. And this is the price or the premium of a call option. Okay. Depending on what you want to do. So in terms of futures, I collected the data from CME. And what I did was I looked at the maturity that I want, okay? So in this case, I'm looking at the time horizon into March next year. So the futures that I'm looking at are the March futures. So this is for the Australian dollars. This is the futures rate. So you can use this for your forward hedge, okay? So you can assume that the forward rate is the same or very close to your futures rate. So with futures, you don't have to worry about the premium. So this is the only thing that you have to worry about. This is F, right? Your futures or your forward rate. Similarly for the pounds, I'm looking at the March maturity again, and I'm just looking at the last trading rate of the futures, okay? So this is going to be the forward rate for the pounds value. Okay, so in the next few slides, I'm going to talk about the assignment content and what is expected. So I think the first thing you want to do is you want to check the marking rubric that I provided at the end of the assignment. So if we go here, let me share with you the marking rubric. All right. So let me enlarge it first. So this is the assignment. This is version 1, and version 2 will be similar, except that you're going to focus on the UK segment. So here is the marking rubric at the end, okay? So this details the level of analysis or the level of debt that I would expect in for each level of grades. So obviously, if you want a higher mark, you need to put in a little bit more effort, okay? And so on and so forth. So this will be the starting point. So before you write the assignment, make sure you read through the marking rubric to see what is expected at each level, okay? Here I've got some information for presentation and references as well. So in terms of reference style, you can use either APA, Harvard, or Chicago, okay? Okay, let me go back to my slide. Right, so in terms of table 2s, I've got a few questions about table 2 scenario analysis as well. So I just want to clarify a little bit. And also I realized that the column title is a bit confusing. So I made a little bit of change here too. Hopefully it will be a bit clearer. So let me go back to the assignment. Now this is the table 2 that you will see in your assignment. So previously, this is what you will see. So you see a forecast Australian dollar net profit, and then unhedged, and then you have the forecast Australian net profit hedge. Okay, so I have changed this a little bit. So in table 2, in the first 3 columns, you're going to be providing the forecast Australian net profit at different levels of exchange rate, right? So if I call X my forecast exchange rate for the March maturity, March 2021 maturity, then I'm going to have a down scenario where X is 10% less and a upside scenario where X is 10% more, okay? So for each of these roles, I'm going to have different hedging strategies. The first one is obviously I'm not doing anything, so I'm not hedging my exchange rate exposure. In the second scenario, I'm going to hedge 100 of my exposure using the forward contract. In the third scenario, I'm going to hedge using the option contract, just option contract 100%. Then in the next few scenarios, I'm going to use both options and forward to hedge my position, okay? So for example, if we look at this role here, so let's say my exposure is 100 million USD, right? So let's just say that's my exposure. So in this particular hedging strategy, I'm going to hedge 75 million USD using forward, and I'm going to hedge 25 million USD using options, okay? So you're going to have to compute the hedge Australian net profit for each of these scenarios, right? When the exchange rate changes using different hedging strategies, okay? Now, in the next column, I'm going to have a column called impact, okay? So in this case, what I'm going to have here is I'm going to compute the difference between the forecast profit, which is what I computed here, okay? And the baseline profit, where the baseline profit is given by your net USD profit. So I'm looking at version 1, so I'm talking about USD profit, okay? So the baseline profit is given by the USD profit for the US segment times the current spot exchange rate, okay? So my baseline is the expected Australian dollars profit that we will get, assuming that the exchange rate does not change at all, okay? So these columns simply just are the difference between whatever you calculate from this table, from these first rows, this first column, sorry, and the baseline, okay? So does that make sense? So for example, if I've got, say, 120 million here in the first cell, and let's say my baseline is 100 million, right? So I'm just giving a very far-fetched example here. So in this case, the impact of exchange rate movements on my forecast Australian net profit for the unhedged strategy in this particular case is going to be 120 million minus 100 million, right? So it's going to be 20 million in this case. Okay. So you're going to do this for the entire table. So the purpose of looking at the impact here is to look at how exchange rate can change your forecast Australian dollar profit. Okay. So to provide you with a more concrete example, let me pull up a previous semester's assignment. Now, to give you a bit more context as well, last semester, the assignment was a group assignment, so it was more comprehensive than this semester. This semester, I cut down the number of questions as well as the level of difficulty, so it's a little bit different. But you can use this as a guideline, nevertheless. So where is mine? Here we go. All right, so let me just share the Excel file from a previous semester. So this is how table 2 in the previous semester looks like, okay? So in this case, you've got your income in the foreign currency, and then you're gonna compute the Australian dollar equivalent of that baseline, right? So this is your net income, and then this is your current exchange rate, okay? So the baseline benchmark is going to be your income in the foreign exchange, in the foreign currency, times the initial exchange rate or the current spot exchange rate, okay? Now, you're going to have to forecast your exchange rates, right? So you're going to do something similar to this. And then you're going to do the 10% up, 10% up and 10% down scenario. So for each of these scenarios, you're going to be computing the expected Australian dollar receipts or profits for each of these scenarios. And then with the impact, you're going to take the difference between your forecast profit and your baseline, okay? So the goal is, as you can see, I'm going to enlarge this screen a little bit. So the goal is you want to see how, when exchange rate changes, your expected profit might change, okay? So the impact columns show you the change in your expected profit whenever your exchange rate changes, okay? So if you want to plot it on a graph, this is how it looks like, okay? So here on the vertical axis, I've got my impact. So I'm looking at how exchange rate is impacting my profit. And on the horizontal axis, I've got the possible future exchange rates, okay? So I've got 3 scenarios from the left to the right. And here I'm plotting the impact for each of the hedging strategies, okay? So as you can see, with the unhedged position, it is very, very sensitive to exchange rates. Whereas if you choose to hedge your position, your profit might change a little bit, but it's not as much as the unhedged position, okay? So this is something you can also provide in your assignment as well. You can plot a graph and then you can talk about it, okay? Okay, let me go back to my slide. All right, so so that was it for the scenario analysis, and this is where I got a lot of questions for. Also, in terms of the forecasting, I think the main point of the assignment is to provide you with a scenario where you can look at different ways to forecast the exchange rate. Whatever way that you choose to forecast the exchange rate, make sure that you back it up using either research or data or facts, okay?
I just had a quick question on that one.
Yeah,
You
sure, Jane.
suggested to use more ways, which is great. Uh, do we then pick one that we find is the best, or do we do an average, or how do we pick which one if we do multiple ways?
So you can look at the previous studies and see what they say about different ways to forecast. So I think in the textbook, the paper look at the forward rate and different other ways of forecasting. I can't remember. So you can use something like that to justify why you use the forward rate.
I get that. I guess my question was, if we use two different ways that are both, or we can both back up, which one do we choose out of that? Is it the one that we think is most sensible, or I
Yeah,
know you said the forward rate is usually the best way, but if we did another way, do we have
yeah.
to choose one, or do you do an average of the two, I guess?
Well, I guess you can argue both ways. So if you have a very strong reason for why you prefer, let's say, the PPP, then cite that. Otherwise, you can do an average. Yeah,
Okay. All right.
yeah,
Thanks.
yeah. Or if you want to be very comprehensive, you can do table 2 for both of the forecasts. Right.
No worries.
Yeah, so that's a good question. So a lot of these things are not like a straightforward either right or wrong decision. You just have to justify the decision, okay, in a sensible way.
Okay.
All right. So in the next slide, I'm just gonna because it's very hard to like understand, you know, what the marker is looking for. So I'm just gonna try to explain what I think is a good assignment. Okay, so that you have some sort of expectation. So how does a good assignment looks like for a marker, right, for a reader? So the first thing I'm looking at is obviously the presentation, okay? So if I get a report that is not properly, you know, worded or the font is everywhere, then that is a really bad signal, okay? So you don't want to send a bad signal to the reader that you haven't put enough effort in it. So nice presentation is unfortunately something that you have to pay attention to. Coherent, so the assignment should be coherent. So when you write the report, you have to think about the reader. So you're telling the reader a story, right? So it has to have like some sort of introduction. And then say, for example, in this report, I'm gonna tell you about the risk exposure of Afterpay, and I'm gonna analyze it in different sections like this, okay? So make sure that you tell the reader a coherent story. Also, this is obviously an academic environment, so I want it to be academically relevant. So make sure that you back up your analysis or argument with research and facts, okay? So for example, I cannot just say, okay, I'm expecting the exchange rate to be 10 Australian dollars per USD next month, right? So that's really unreasonable. So you're going to have to back up your analysis with some sort of research or facts. Finally, but very importantly, so for employment purposes, I want the assignment to also be industry relevant, right? So when you write the report, just pretend that I'm your CEO or something like that. So you're writing to a person that wants to make decisions based on the analysis that you do, okay? So make sure that you sort of provide some background understanding of the industry, of the key competitors, or the key challenges of the industry that you think is relevant for your analysis. Also show some understanding of the company's past performance and its current strategy. So the company that I picked for this semester is Afterpay, which have attracted a lot of attention, right, in the recent months or so. So it shouldn't be very hard to find some useful information on the newspapers, okay? So, so this is what I want to discuss about the assignment. So I'm opening the floor for questions. If you have any questions at all, then feel free to let me know.
Just on that last point there, keep it relevant, pretend you're the CEO. Does that mean we write I believe or I in my analysis? Do we keep it in, do we talk about us or how do we present it that way?
Yeah, you can use first person. That's fine. Yeah.
Okay.
So even in academic research, we write in first person as well. Yeah. I think it's a new thing these days. It used to not be the case, but yeah. So these days you can just use first person.
Okay, great.
Yeah. So I've got 2 questions in the chat box. Let me just check. So the first question is, we have to calculate from September for the next 6 months. Yes, correct. So yeah, sorry. So the financial statement I got from Afterpay was in February, but for the purpose of forecasting, we're looking forward. So we're gonna be looking at September to March next year. Okay. Next, have a question about the accuracy and validity of websites to find the required expected inflation and also expected interest rates. Okay, so if you go to the central bank or the Bureau of Statistics websites, you should be able to find the interest rates and inflation rates. So these are quite common data that you can find. Yeah, so if you get some information from government websites, then it's definitely very valid. Okay. Also, if we find these data around February, such as January, March, April, can we apply those instead of February? I'm not sure I understand this question here, Nikit. So we're forecasting until March 2021, right? So you want a inflation rate that covers that period. Okay, so in other words, anything close to March 2021 will be good. Okay.
Hello, ma'am.
Yes.
Yeah, I just like to know, whatever you explained us currently, would this recording be available to us so we could go through it again?
Yeah, so this will be recorded and will be available by Friday.
Okay, fine. Thank you so much.
Yeah. Okay. So basically, I think with this report, I just want to see whether you understand how to use forwards and options to hedge your exchange rate risk exposure. And here we're just looking at the cash flow exposure, right? And I just want to see whether you can write a report that can communicate your analysis to the reader. Okay. Any other questions at all?
I guess how much introduction to Afterpay should we start with the reports, and how much do we just dive? I guess you're the CEO of Afterpay, so we kind of just dive straight into the analysis.
Yeah, that's a good question. Yeah, so even though you can pretend I'm a CEO of Afterpay, which is very unrealistic, but at the same time, this is an academic assignment. So in terms of the introduction, I think something around 1 page would be good.
Okay, is this a format of a cover page, table of contents, executive summary type report?
Yeah, exactly. Okay. So it's a business report format.
Great.
Yeah. Okay. Any other questions, guys?
Well, I have a little ambiguity in this question. In the question, it is stated, just imagine it's February 2020 and we have to forecast for incoming 6 months, which is August, which is already passed. It's a bit confusing.
Yeah, sorry. So as I mentioned before, so I should have changed that to the assignment deadline. So you want to forecast from September to March next year.
All right.
Yeah. Sorry, I wrote the assignment in February, so that was
all right. That's okay.
Yeah.
Thank you.
Yeah. All right, so if you have no other questions, let me jump into our workshop. Okay. Of course, I'm happy to take questions during the break as usual. Let me find my workshop first. Sorry guys, here it is. There you go. Okay, so for workshop 10, we are just going to continue with the foreign exchange rate risk management topic. And for the purpose of the assignment, this is not something you're expected to do, okay? So this is economic exposure where you look at asset values, but in the assignment, you're just hedging a cash flow, okay? So last week was more relevant to you than this week in terms of the assignment. So for this lecture, we are continuing with the second part of the topic, and we're talking about economic exposure and operating exposure. Okay. So briefly, with economic exposure, we're talking about how exchange rate movements can change your firm's asset value or the firm's value itself. And this does not apply to just companies with overseas dealings. It applies to all companies, right? As long as the exchange rate movements can change the competitiveness of the industry. Okay. So, for example, if you think about, let's say, the market for soft drinks, okay? So, suppose we have a company that only produces soft drinks and sells to the domestic market, okay? But your competitors might come from overseas, okay? So your competitors could be Coca-Cola, Pepsi, so on and so forth, okay? So when the exchange rate moves, it might make your competitors' goods more or less expensive, okay? And that would change the competitiveness that you are faced with, okay? So unlike transaction exposure, which we talked about last week, with economic exposure, we're talking about the impact of exchange rate movements to companies regardless of where they are operating overseas or operating domestically, okay? So as long as your competitive position change, then you will be exposed to some economic risk, okay? We can also break economic exposure down to operating exposure. So in this case, we're looking at the impact of exchange rate movements on the firm's cash flows, okay? Operating exposure is a little bit complex to measure, and we'll talk about it later on, because we have to analyze the competitive landscape of the industry to be able to understand operating exposure, okay? So to contrast between transaction exposure, which is what we talked about last week, and economic exposure, which is the focus of this week. So transaction exposure focuses on one particular transaction. For example, you have an account payable that is expected in 3 months, okay? So in this case, you would only be exposed if you trade with an overseas partner, okay? And with transaction exposure, it's quite straightforward to hedge because you know exactly the size of your exposure. For example, if you have $1 million of account receivable from a US company, then you know that the amount that you're exposed to exchange rate risk is 100 million USD, okay? You also know exactly how much your position will change when there is a 1 unit change in the exchange rates, okay? So for example, I don't know why I used the pound here and the USD in the previous example, but anyway, so assuming that the pound is the foreign currency in this case, so when the pound appreciates by $1, you know that the account receivable that you're expecting is going to increase by $1 million as well, okay? So it's a straightforward 1-to-1 ratio. With economic exposure, you're focusing on the entire asset value or liability value. Okay, so in this case, it's a little bit harder to measure because it depends on two things. The first thing is the exchange rate movement itself, and second, how much your asset value in the foreign currency might change when the exchange rate moves. Okay, so I'll talk about it later on in an example. So if we define economic exposure as the sensitivity of the future home currency value of the firm's asset, then we can measure the we can build up some measure of sensitivity to capture economic exposure. Okay. So in economics or in economic metrics, if you want to measure sensitivity, right, you can rely on a regression like this. So for example, if I want to measure the sensitivity of P, which is my dependent variable, and an explanatory variable, which is S, then I can run this regression here. So what I have from this regression is a beta coefficient, which is the coefficient for the S variable. Okay. So what beta tells you is it tells you how much P would change when S changes by 1 unit. Okay. So by definition, beta captures the sensitivity of P to S. Okay. So this is the idea behind using this model to measure the economic exposure or the sensitivity of your firm asset value to exchange rate movements. Okay. So with this regression here, P is the domestic currency value of the firm's asset. Okay, for example, in the AUD. So this is what we want to find. Okay. S is the explanatory variable of interest. In this case, is the exchange rate. Okay. Alpha is the constant, so it doesn't change with the exchange rate, so you don't have to worry about it. E is an error term, and if we assume it to be a random error term with mean 0, then this is something you don't have to worry about as well. So the coefficient of interest here that we want to capture is the beta coefficient, which tells you how much sensitive P is to a movement in S. Okay. So by definition, this captures economic exposure. Okay. Just something on the side note. So the underlying assumption here is we assume that S follows a normal distribution. Okay, so when you want to rely on a OLS regression, you've got to be able to assume that your independent variables are normally distributed. Okay. Also, another assumption is that you assume the relationship between P and S is linear. Okay, so it's going to be a straight line. Which is something not very important. So the key takeaway here is the beta coefficient here tells you how much P is sensitive to S, okay? And this is your economic exposure. So to measure the beta coefficient, you can rely on this equation here. So this is the definition for beta. So beta is the covariance between P and S divided by the variance of S, okay? Which means that there are two sources of economic exposure. The first one is the variance of the exchange rate itself. And the second is the covariance between the exchange rate and the asset value, okay? So just to recap, so these are the formulas that we are going to use to compute the variance and the covariance, okay? So let me explain each of them in detail. So the first one is the formula that you can use to compute the probability weighted average. Okay. So for example, if I have, say if I think about the next 6 months, okay, so I think that maybe the Australian dollar is going to be worth, let's say 1.2 US dollars in 6 months, okay. I think this probability could be quite low, so maybe 20%. Alternatively, the Australian dollar could depreciate to maybe 0.6, okay, USD in 6 months' time. I think this is more likely, so I'm going to assign a probability of 80% to it, okay? So if I want to compute the expected Australian dollars value based on what I think about how the future looks like, then what I can do is I can compute the probability weighted average, okay, of the two guesses that I provided before. So in this case, given a 20% probability of the Australian dollar being 1.2, I'm going to write 0.2 times 1.2. And an 80% probability of the Australian dollars being 0.6. So I'm going to write 0.8 times 0.6. Okay. So this will be my average expectation of what the Australian dollar looks like in 6 months' time. Okay. Let me put it in the calculator. So this will be 0.72. Still very optimistic. All right, so this is what we call the probability weighted average, okay? So if you think that the future might contain different probabilities and you want to compute just one expected value of that future, then you just take the probability weighted average of all the future probabilities, okay?
Excuse me, ma'am. I'm sorry to interrupt here. Can I please know what is 0.2 and 0.8?
That's the probability, sorry. I should have, yeah. So, yeah, so this is 20% and this is 80%.
So the probability of, Australian dollar be 1.2 is 0.2 and 0.6 is 0.8. That means
Exactly.
20% and 80% probability.
Yes, exactly.
All right.
Yeah.
Thank you, ma'am.
Yeah. And I must add as well, so the sum of all the probabilities should sum up to 100%, okay? Right. Okay, so in this formula, it's just exactly the same as what I just mentioned before. So in this formula, we are calculating the probability weighted average of all the future possibilities, right? So PR here is the probability. So PR1 is the probability of scenario 1. So in the previous example, it would be 0.2, okay? So 20%. Probability 2, so on and so forth until the final probability, right? So the sum of all the probabilities should add up to 1. In the second formula, I'm looking at the variance of x, okay? So how much x varies across different scenarios, across different probabilities, okay? So in this case, it's going to be the probability weighted average of the sum of square, right, of these different square terms, okay? So here for scenario 1, I've got probability 1 times x1, which is the value of x in scenario 1. So in my previous example, it's going to be 1.2. And x bar is the expected value that we computed before, okay? So in my previous example, it is going to be 0.72. Okay, and then square it up and times it with the probability. Right. So here you're capturing how much X varies from one probability to the next, okay? Or from the mean, sorry, I should say from the mean. So the greater the variance number, the more volatile X is. The third formula is to compute the covariance between X and Y, or how much X and Y move together. Okay, so when you have a higher covariance, that means X and Y move together more closely and vice versa. Okay, so similarly, we're going to have probability 1 for scenario 1 times x1 minus x bar and times y1 minus y bar. Okay. So on and so forth. So you just sum up all the probabilities here. Okay. So applying the formula to compute the covariance for P and S and the variance for S will allow you to compute the beta coefficient. Right? Okay. And this will reflect the economic exposure of the company. All right. So let me give you a few examples of how different companies might be exposed to economic exposure differently. So we have 3 different scenarios here, case 1, case 2, and case 3. Let's say these are 3 different companies, okay? I'm just going to use the banks as our example. In this case, CBA. All right, so for each of the cases or for each of the companies we're looking at, we think that in the future there could be 3 possible scenarios, okay? So in scenario 1, this is how the values of the assets look like. In scenario 2, this is how it looks like, and in scenario 3, that is how it looks like, okay? We think that the probability for each of the scenarios is going to be the same. So each occupy 1/3, okay? So about 33%. So they are equally likely to happen. Now, in the first scenario, P star here is the foreign currency value of the asset. S is the exchange rate, domestic over foreign, and P is the domestic value of the asset, okay? So as you can see, if you times S with P star, you'll get P, the domestic value, okay? So in case 1, when the exchange rate increases, right? So as you can see, if you go from state 1 to state 3, the exchange rate increases, yeah? So here, as the value of the euro increases, what happens here? What happens is the euro value of your asset also increases, okay? So in this scenario, P star and S, or the foreign currency value of your asset, and the foreign currency value increases together and decreases together, obviously. So they have a positive correlation, okay? So when one increases, the other increases as well. So the impact of that on your domestic asset value is that the movement in the exchange rate is further exacerbated by the movement in the foreign asset value, okay? So when your when your when your foreign asset value has a positive correlation with the exchange rate. This is when you have a higher economic exposure, okay? Because the two sort of move together, so the exposure is exacerbated, okay?
Excuse me, ma'am.
Yeah, sure.
In this example, shall I assume that $1,372 is equal to 980 euros?
Where is it? So 1,000, oh here?
It's P star and P.
Yeah. So this number here is the product of these two numbers.
Okay. Yeah. Got it, ma'am.
Yeah. So this is the domestic value of the asset, which is given by the foreign value times the exchange rate. So that was the first scenario. In the second scenario, what we have here is quite interesting. So as you can see, when your exchange rate increases, right? So when the foreign currency appreciates, what happens here is your foreign asset value depreciates or decreases, okay? So there is a negative correlation between the foreign asset value and the exchange rate. So as the two move in the opposite direction, the economic exposure will be minimized or will be offset by the two offsetting movements, okay? So the impact on the domestic value of your asset is going to be smaller, okay? So in this particular case, this is a special case where you have a perfect negative correlation between P star and S, so that the two perfectly offset each other, okay? So as a result, your domestic asset value remains unchanged, okay? So in this particular case, case number 2, you will not have any economic exposure because your domestic asset value is going to be the same regardless of how the exchange rate moves, okay? In case number 3, so in this case, your exchange rate changes in different scenarios, but your foreign asset value stay fixed, okay? So this is fixed and this changes. So as a result, the domestic value of your asset is going to be fully determined by changes in the exchange rate, right? So there's no change in the foreign asset value at all. The only change will happen with the exchange rate, okay? So in this case, case 3 will be similar to a transaction exposure in the sense that you will only have to worry about hedging 1,000 euros, okay? Regardless of how the future looks like, your exposure is going to stay fixed at 1,000, okay? So you have some exposure here, but it is quite easy to fix because you can just use a forward contract or something like that. All right. So I've got more details in the lecture slides, but for the purpose of the summary, I'm just going to go through the hedging of each of the cases briefly, okay? So in case 1 that we just talked about before, if we want to compute the beta coefficient, so if we want to compute the covariance of PS and the variance of S, and then we divide it by each other, then we'll find that the beta here is 1,700, okay? In case number 2, as we look at before, there is no variance in the in P, okay? So P does not covary with S at all. As a result, your beta is going to be 0. that means you have zero exposure to exchange rate risk. In case number 3, beta is going to be exactly the size of the foreign asset value, which is 1,000 euro in this case. Okay, so if that's the case, then your problem will be simplified to a transaction exposure. Okay. All right. So in this case, if I want to hedge the exchange rate risk for these 3 different companies, now we mentioned before that with case 1 and case 3, we've got some exposure to worry about because our asset value will change with the exchange rate. Okay. In case number 2, this is when we don't have to worry about exchange rate risk at all because our asset value will always stay the same. So as a result, if I'm talking about hedging, I'm going to be just focusing on case 1 and case 3. Okay. So for case 1, if I choose to hedge, now if you have a positive beta value, that means whenever exchange rate increases, then your domestic asset value increases as well, and vice versa, right? So in this case, you will make a loss if the exchange rate depreciates, okay? So to hedge this exchange rate exposure, you therefore want to enter into a short forward position, okay? So if I illustrate it on the graph, so this is my asset value and this is the exchange rate. So for case number 1, when the beta is positive, I'm looking at a positive coefficient. I'm looking at a positive relationship here. Okay. So my exposure is, I'm going to make a loss when exchange rate depreciates. Okay. So to hedge this position, I'm going to enter into a short forward position. So if I do so, so this is the value of the asset in different scenarios if I choose not to hedge, right? So this is the unhedged position of my asset. So as you can see, this will be the variance of the asset value of P, which is quite high. So if I choose to hedge using a short forward contract, then under each of these scenarios at different levels of exchange rates, I can compute the payoff of the forward contract, right? As a result, for a hedge position, it's going to be a combined position between the unhedged asset and my forward contract, okay? So in this case, if I compute the value of the hedge position for each of these scenarios, I will find that these are the values, okay? If I compute the variance of P in this second case, then I'll find that it will be much smaller relative to when I don't hedge the exposure, okay? So similarly for case 3, if I choose to hedge the exchange rate exposure for case 3, I'm going to be short £1,000 forward. So this is the value of the asset without hedging. And this is the proceeds from hedging from the forward contract. So in this particular case, if I choose to hedge this position, my variance of the asset value is going to be 0, okay? So in this case, I've got a perfect hedge because this is the case where I have something similar to a transaction exposure, okay? All right, so for most of our workshop today, we're going to be focusing on economic exposure. So we're going to work through some of the examples to do exactly just that, right? So we're going to be hedging economic exposure using the beta coefficient. In the second part of the lecture, we also talk about operating exposure. So this is when we focus on the firm's cash flows or the firm's competitive position, okay? So a good definition of operating exposure is the extent to which the firm's operating cash flows might be affected by exchange rate movements, okay? So this is not very easy to measure because when exchange rate moves, it might affect your competitive position, okay? And as a result, you might have to do some scenario analysis or simulation to work out how much operating exposure you're talking about, okay? So in some of the questions that we'll go through today, we can discuss some of the issues or some of the determinants of operating exposure, including market structure, the firm's ability to adapt to the new market structure, so on and so forth, right? All right. So that was the main points of the lecture for week 10. Is there any questions at all regarding the topic today? So far, so good. Okay, so we are right at 3:06. So maybe we should take a short 5 minutes break and we'll come back at 10:00, okay? Then we can go through the tutorial questions.
Okay, no worries.
So I'll see you guys back in 5 minutes.
Yep, thank you.
Okay, let's come back, guys. So let me go through the theory questions first, as usual, and then we move on to the practice questions, okay? So for the first theory questions, in this case, we've got a company an American company that export cars to Spain. And what happens here is we have an appreciation of the dollar against the euro, okay? So this is bad for General Motors because it makes their cars more expensive in the Spanish market, okay? So in the Spanish market, GM faces competition from the Italian and French car makers who operate in the same currency, right, in the euro. So in this case, if you need to advise GM on what to do with their market in Spain, what will be your advice? Okay, so what are the strategies to get around the more expensive dollar value? So one thing I can think of is maybe trying to diversify to different other markets, okay? So maybe sell more to your Asian clients or some other markets where the dollar is still a little bit soft, or maybe target the Latin American countries where some of them peg their currencies to the dollar, okay? What else can you do? You can also think about expanding your production to the euro, okay, to Europe, so that your production cost is going to be in the euro as well. So as we mentioned before, either diversify into different markets where your currency is too soft, or you might locate your production in Spain or in other European countries where you can produce at the euro, in the euro, okay? So this could be something that you might want to discuss in your assignment. If you think that exchange rate risk is very important for Afterpay, then maybe recommend some other operational strategies to minimize the exchange rate risk as well. Okay. And this will require an understanding of their business model as well as the market they are operating in. Okay. Question 8, what are the advantages and disadvantages of financial hedging versus operational hedging? Okay. So financial hedging is when we talk about things like using forwards, futures, or options. Operational hedges are something similar to what we discussed before, where you change your location to a different country, or you change maybe your invoice to your home currency, so on and so forth. Okay. So one of the things with financial hedging is that it is relatively easier to do relative to operational hedge. Okay. So as you can imagine, if you want to open a different factory in Spain, in the previous example, it is relatively expensive. Okay. Whereas with financial hedge, you can decide to buy an option or buy a forward contract that does not cost that much. Okay. Anything else? So with operational hedge, right? So once you establish a production site in a different country, you're going to have to stick with it for a while. Okay. You can't just build a factory today and then tomorrow you sell the factory. It's going to be very costly. So operational hedge is going to be a little bit more costly and it's not very easy to reverse. Okay. So once you commit to building a factory, then you got to commit for a while. At the same time, with operational hedges, it's a long-term strategy. So you could hedge your exchange rate over a 5-year or so on and so forth window. Whereas with financial hedging, financial instruments, normally derivatives instruments are not very long. Okay, so you can hedge for like a year or so, but if you look at the a 5-year window, it's a little bit harder to do. Okay, with financial hedges. All right, this is also an important question in terms of an important question conceptually. So we talk about how exchange rate movements can affect the firm's exchange rate risk exposure, right? So we mentioned before that when the exchange rate moves, let's say for 10%, so on and so forth, your asset value might change by a certain percent, okay? Now, in practice, sometimes even when the exchange rate is very volatile, but your exchange rate risk exposure might not be that high, okay? So even when you have a very volatile exchange rate market, your exchange rate, your actual exposure might not be too much, okay? And why is that the case?
Because we can hedge?
Exactly, it's spot on. So sometimes you can hedge, right? Especially if you have a factory in your product market, then that will provide you with a natural hedge. Okay. Anything else? So one, you can hedge. The second reason is, besides the fact that you can diversify your market to minimize your exchange rate exposure. In the scenario that we looked at before, right? So with the example where we have 3 different cases, we said before that with case 2, in the case when your asset value moves in the opposite direction to the exchange rates, then that provides you with a sort of natural hedge in the sense that the 2 movements offset each other. Okay. So sometimes your asset value might move in the opposite direction of the exchange rate, and that will provide you with a lower exchange rate exposure. Number 3. So sometimes even when the exchange rate moves a lot, but if it as long as it's a nominal movement or it's a nominal change, then your competitive position might not be affected. Okay. So for example, when we talk about the international parity conditions, we mentioned that as long as the PPP holds, then the firm's competitive position will not be affected. Okay. So this is when, so when you have the, so whenever the exchange rate moves, when you have a corresponding change in the price levels in 2 different countries that offset the movements in the exchange rate, that is when your competitive position will not be affected. Okay, so in this case, even with a very volatile exchange rate market, it will not affect your competitive position. Okay. All right. So moving on to the problems. So with this topic, I find that the calculation for this topic is very long, and it could be quite complex, but the concept is not very hard to understand. Okay, so the question tends to be straightforward, even though the calculation could take a little bit of time. So as an example, let's look at question 1 here. So in question 1, assume that you're a US citizen and you just buy a piece of land in the UK. Okay, so you want to hold the land for 1 year. So you just bought it today and you want to hold it for 1 year. So in the future, when you think about selling the land, you think that there could be different scenarios. Okay, so in 1 year's time, if the British economy booms, then you think that in that case, you can sell the land for £2,000. At the same time, in that particular scenario, you forecast that the British pound is going to be worth 1.4. Okay, so in scenario 1, I'm going to call this the boom scenario. Your P star, or the foreign asset value, is going to be £2,000, and S, which is the exchange rate, is going to be $1.4 per pound. Okay. In the second scenario, when the economy is not doing so well, so this is when you have a downturn, you forecast that the land will be worth only £1,500, and at the same time, the pound value is going to be 1.5. Okay. So you guess that there will be a 60% chance of a boom time and a 40% chance of the downturn. Okay. So PR1, I'm going to call PR1 for scenario 1, is going to be 60%. And PR2 for the downturn is going to be 40%. So we only forecast 2 possible scenarios in the future, and as a result, the 2 possibilities should add up to 100. Okay. So in this kind of question, most of the time you're going to be asked to compute your exchange rate exposure, okay, or your economic exposure, or the beta coefficient. It is going to mean the same thing. Okay. So in question A, estimate your exposure beta to the exchange rate risk. In other words, compute the beta following this formula over here. Okay. Question B, compute the variance of the dollar value of your property that is attributable to the exchange rate uncertainty. So I did not touch on this before when I summarized the lecture, but if you go back to the original lecture slides, you will see a formula to compute the variance of the portfolio. that is due to the exchange rate uncertainty. Okay. C, discuss how you can hedge your exchange rate risk exposure and also examine the consequences of hedging. Okay. So normally with this kind of question, question A will always be asked. Okay. So you would always be asked to compute the beta coefficient. So let's do that then. Let's start with writing down the formula to compute the beta for this particular case. I'm going to start a whiteboard, and we can do that from there. Okay. So this is my whiteboard. I'm just going to write the relevant information in here. So in this case, if I summarize the information, I'm going to construct a table where I'm going to have scenario 1 for boom, and then scenario 2 for Dow10. Here I'm going to have the probability for each scenario. So for boom, it's going to be 0.6, so 60%. For Dow10, it's going to be 0.4. In scenario 1, P star is going to be, so I'm a US citizen, so P star is going to be in the pounds. Okay. So here 2,000 and 1,500. Exchange rate. I forecast the exchange rate is going to be 1.4 for the boom and 1.5 for the Dow10 scenario. So this is going to be USD or the pound. So this is all the information you need, guys, for question A. Okay. So 8, compute beta, where beta is equal to the covariance of PS and divided by the variance of S. Okay. So if you haven't already, I'm just going to go back to the formula that we saw before, right? For the average, the probability weighted average, and the covariance and variance formula. Okay. Where is my formula? Right. So you will need these formulas to work out question 8. Okay. So write it down if you haven't already. Okay. All right. So it kind of messed up my format here. I'm sorry, guys. I'm not sure why. Anyway, but you know what I mean here. never mind. Alrighty. So let's compute the beta, okay? So normally this kind of question will be done easier on Excel. So what I normally do is I'm going to set up an Excel spreadsheet, and then I just use the Excel formula to compute the numbers for me, okay? So normally I'm going to have a table that looks like this. I'm going to have the probabilities for each of the scenarios. So let's call this 1 and 2. Then I'm going to have P star, so 2000 and 1500. Then I'm going to have S, which is 1.4 and 1.5 in this case. Okay. So the next thing I'm going to do is I'm going to need to compute the P value, okay, which is the domestic value of the asset. So here what I've got is P star, which is the foreign value, but what I want is the P, which is the domestic value in the USD. Okay. So if my asset is 2,000 pounds, and if the exchange rate is $1.4 per pound, then if I want to compute the dollar value of the asset, how much would that be?
$2,800 for the first one.
2,800. Yes, correct. So I'm just going to take 2,000 times 1.4. The second one.
I got 2,250.
2,250. Yep, that's correct as well. So in the second case, I'm also taking 1,500 and times it with 1.5. So 2,250. Spot on, James. So step 1 done, I have computed the P, okay? So what I need to do next is that I'm going to have to apply the covariance and the variance formula, okay? Which were the two long formulas that you saw in the slide before. So before I can compute the covariance and variance, I'm going to have to compute P star and S star, right? Because they are required for both of the formulas. So if I do this in Excel, I'm going to compute S bar in this cell over here, right below the column for S. And I'm going to compute B star here, which is right below the column for P. Okay. So if I want to compute S bar, how can I do that? Can someone help me with this calculation? So S bar would just be the probability weighted value of S. Okay.
So just 0.6 times 1.4 plus
Exactly.
0.4 times 1.5.
Exactly, spot on. So I'm just going to take the probability for scenario 1 times the value of S in scenario 1 plus the probability of scenario 2 times the value of S in scenario 2. Okay, which is given by this formula here. So I'm just going to do some quick calculation. So I have 1.44. Did you guys have the same answer?
Yeah.
Thank you. And if I want to compute B star, I'm going to do the same thing. P1 plus PR2, P2. So in this case, I'm going to have, sorry, 2,580. Okay. So once I've got the S bar and P bar, which is the weighted average of S and P, I'm going to use these numbers for the covariance and the variance formula. Okay. So for this particular question, I'm going to help you compute these two numbers. And then for the next question, you guys can help me. Okay. So with the covariance, I'm going to take probability 1 times S1 minus S bar times P1 minus P bar. Plus probability 2 S2 minus S bar P2 minus P bar. For the variance, it's going to be PR1, probability 1 times S1 minus S bar square plus PR2 times S2 minus S bar square. Okay. So if I'm doing this on Excel, I'm going to create a new column for S minus S bar. Okay. So for this particular cell, I'm going to have 1.4 minus 1.44. And then for the second scenario, I'm going to have 1.5 minus 1.44. Okay. So that will help simplify the calculation a lot. Well, of course, you can use the calculator as well, but I think Excel is a little bit easier. In the next column, I'm going to have P minus P star, P bar, sorry. So once again, I'm going to have 2,800, which is P1, minus 2,580, which is P star. And then for the second scenario, I'm going to do the same thing. Okay. So I run out of space here, but if this is an Excel file, I'm going to create another 2 columns for these products here, okay? So I'm gonna just keep creating the columns, and I'm gonna do the calculation accordingly, okay?
Come exam time, are we allowed to do this on Excel and then copy this over onto the exam?
Yeah, sure. So you can do the calculation on Excel and then you copy it to the exam. But you have to show your formula, okay?
Okay.
Yeah, so for example, in this question, I don't have to write like PR plus this and that, but what I have to write is I'm gonna have to write 0.6 times 2,800 plus 0.4 times 2,250, and that will be equal to such and such, okay?
Yeah.
And I will have the unit here. All right, so if you have done this question before at home, can you tell me what is beta? So in this case, I've got a covariance of minus 13.2. And the variance is going to be 0.0024. Okay.
Negative 5,500.
Exactly, spot on. So beta here is going to be minus 5,500 pounds. And this will be your exposure to economic exchange rate risk. Okay. So when you have a beta of negative, that means when the exchange rate move up, then your asset value move down. Okay, so there's a negative relation between your exchange rate and your domestic asset value. So here, negative relationship between exchange rate S and domestic asset value P. So when you have a negative relationship between S and P, so this is P and this is S, you're looking at an asset value that looks like this. Okay, so you're looking at a downward sloping line. So you will lose out, or your asset value will decrease when the exchange rate increases. Okay. So in this case, if you want to hedge your exchange rate exposure, you want to enter into a forward contract that looks like this. So this is a long forward contract. Okay. Does that make sense? So when you want a contract that offset the movement in your asset value.
And would you explain 5,500 euro in this graph? Because it's a bit high number for sensitivity.
Yeah, so the 5,500 is going to be the slope of this line here. So the slope of the line is 5,550. So, so that's how much you are exposed to exchange rate risk, I guess. Does that make sense? Does it make a bit more sense? So this number here shows you the size of your exposure.
Based on $1 or £1 change, according to what changes?
No, it's like let's say in our previous topic, right? When we have an account payable of 10 million pounds, then the size of our exposure is 10 million pounds. In this particular case, when we capture the exposure that we have, it is going to be 5,500 pounds. So this is not the change, but this is the level of the exposure, if that makes any more sense, or level of exposure.
And what would a factor be to determine if that size is large or small? Just compare it to other similar exposures or what? It's 5,500, I think what she was saying. Is that a large number or is that a small number? Or how can you tell?
Yeah, I see what you mean. Yeah, I'm not quite sure. I think it's just, so I can say 5,500 is a larger exposure, let's say to 1,000 pounds. And it's smaller than 10,000, obviously. Yeah, but that would be my interpretation of the number.
I guess it's just circumstantial to the situation. Right?
Yeah, yeah.
The prices are £2,000 and £1,500, but the risk exposure is 5,000, which is a huge number according to the original price. So it doesn't make sense, maybe to me.
Yeah, it kind of look a little bit weird too, and I'll show you why later on when we incorporate the hedging into it. So the purpose of calculating the beta coefficient here is to determine how much forward contract you're going to enter into, if that makes any more sense. So later on, I'll show you that so by hedging this amount of pounds, then you basically immunize your asset value from exchange rate risk. Yeah, I think it will make more sense if I show you the forward hedge.
So I guess this beta isn't to determine if we should do it or not. This is just showing us the exposure, and then we decide if we want to hedge that much or not. Correct?
Yeah, exactly.
And then that will determine if we want to go ahead with it, if we want to hedge. Okay.
Yeah. Right, so if I go back to the question, so the beta tells you how much exposure you have, and then you can decide you want to hedge or not. So from the beta that we computed before, in the second question, we are asked to compute the variance of the dollar value of your property that is attributable to exchange rate uncertainty. Okay. So if you think about the variance of the entire portfolio as a big circle like this, then what you want to capture is you want to capture the part of the variance that is only attributable to exchange rate movement. Okay. So in the lecture slide, I provided you with the formula to compute the variance of the portfolio attributable to only the exchange rate risk. Okay, so this is meant to be beta squared times the variance of S. So the source of this equation comes from the original regression that we looked at before. Right. So if you compute the variance of P, or the total variance of your asset value, it's going to be comprised of different components, including the variance of each of the individual components. Okay. So it's going to be a function of the variance of alpha, the variance of beta S, and the variance of E. Okay. So this is equal to beta square variance S, because beta is a number, it's a constant. Okay. So the variance of alpha is going to be 0, because by definition, alpha is a constant. It does not change. Okay. So this is 0. In terms of the error term, if we have a random error term with a mean of 0, then the variance will be 0 as well, okay? Because the mean is 0 and it varies randomly. So the proportion of the variance of P that is attributable to the exchange rate is going to be given by beta squared times variance of S. Okay. So applying this formula here, then beta is what we computed in part A. We're going to take 5,500 square times the variance of S, which is what we computed before as well. And we get this number here. So this is the proportion of the variance of P that is attributable to S. So yeah, so as I mentioned before, with this kind of calculation, this kind of question, the calculation is long and hard, but the question is quite straightforward. Okay, it's just applying the formula.
Will we always have a negative value for beta, and that will, if it's positive, then we won't need a hedge, right? So it should always be negative to show the exposure? Or
No. So
No.
the negative and positive will show you the sign of the exposure.
Right. So what would be different if beta was positive? What would that tell us?
So if beta is positive, that means whenever the exchange rate moves up, your asset value moves up as well. So
It
here,
shows us the relationship.
yeah. So you're looking at this for a positive beta. Yeah.
Okay, that makes sense.
So in question C, in question 3 later, we're looking at a positive beta case. So in question C, discuss how you can hedge your exchange rate risk exposure and also examine the consequences of hedging. Okay. So we sort of talked about question C before when we solved for question A, right? So in question C, if you have a negative beta, that means whenever exchange rate increases, your asset value decreases. So to hedge this exposure, you want to be taking a long position in the forward contract, okay? So you buy forward. So by definition, if you do so let me just draw the graph to illustrate. So here is your position and here is your forward contract, right? So similar to what we did before in a previous topic, when we enter into two opposite positions, then our overall position is going to be a flat line like this, okay? So basically we have eliminated any movement in the asset value that is attributable to exchange rate movement, okay? So in other words, by doing so, you have minimized the exchange rate risk on your portfolio value. Right, so in question 2, we've got a similar problem like before, where we've got different scenarios and we need to compute the beta for the case, okay? So these are all the information for different scenarios that we have. And once again, this example illustrates why Excel is a little bit better relative to using the calculator for this question, okay? So as you can see with this calculation, you've got 4 different states. So if you put it in the calculator, it's going to take you a bit of time, okay? For each of the states, we're going to have an equal probability. So 1 divided by 4 is 25%. And once again, all of the probabilities should add up to 100. We're given the spot rate for each of these scenarios. And we are also given the foreign value of the asset. So this is the euro. Finally, the question helps us compute the domestic value of the asset as well, okay? So we've got S and we've got P. which means that we can compute the beta coefficient for this question. Okay. Okay, so we are now 5 minutes to 4. So maybe let's take a break, and during the break, you can try to attempt the question as well, so that when we come back, we can talk about the answer. Okay, so this is just the same thing that we did before for a different case, that's all.
Okay,
All right.
no worries.
So I'll see you guys back in 5 minutes. Okay, guys. So let's go through, let's solve part A of this question, okay? So as I mentioned before, you can use Excel to solve this kind of question. So when you're doing the question, I'm going to set up an Excel spreadsheet so I can illustrate to you guys in 5 minutes or so, okay? So this is how my Excel spreadsheet is going to look like. So this is the information from the question, right? So I'm just gonna put a box around it. Okay, and this is what I'm going to compute. So I'm going to compute the S bar and P bar first. So this is the probability weighted values of the spot rate. You can simply just take the sum of these divided by 4, but just in case when you have different probabilities, you can set up your formula like this, okay? For P bar, it's the same thing. I'm going to take the probability weighted average value of P, and in this case, it's about 1,430. Next, I want to compute the P minus P bar. So I'm going to take the value of each of P for each scenario, and I'm going to minus it with P bar. Okay. I'm going to do something similar for S minus S bar too, so that I can set up my covariance and variance. Okay. So for the covariance, it's going to be the sum of the probability of the product of P minus P bar times S minus S bar, right? So I'm going to do that first. So for the first stage, I'm going to take the probability times P minus P bar times S minus S bar. Okay. I'm going to do the same thing for state 2, state 3, and state 4. So the covariance here is simply just the sum of the 4 different stages. Okay. So I'm going to take the sum of each of the rows that I have just computed. Then for the variance, it's going to be the probability times the square of S minus S bar, right? So I'm going to take the probability times S minus S bar. What am I doing here? So S minus S bar square, right? So once again, I'm just computing the sum here, and that is it, okay? So to compute beta, I'm going to take the covariance divided by the variance, okay? It's gonna look a little bit big. So the correct currency here should be the euro. Okay, so the beta here is about 2,400 euro. That is my exposure. Let me check if my answer is correct. Yeah, the answer is correct. Okay, so if you want to use Excel, then this is quite easy. If you intend to use Excel in the exam, then maybe it's also good to attach your Excel file to the exam answer as well, just in case if you didn't write down the step-by-step workings, and you can check your Excel file. Okay. No, I'm not going to save. So if I go back to my slide, all right, so we have computed the beta coefficient for this case, and we find that it's about 2,400 euro. So in the second question, we are asked to compute the variance of the dollar price of the asset if the US firm remains unhedged against this exposure. Okay, so if you don't hedge this exposure, then your variance is going to be the total variance of the portfolio. Or in other words, you're simply just computing the variance of P, okay? Or the total variance. I'm going to call this total variance. So to compute the variance of P, I'm just going to apply the formula that we used before, right? So the variance is simply just the probability weighted sum of square. So here what I have is probability 1 for state 1 times P1 minus P bar plus probability 2 P2 minus P bar square, so on and so forth, okay? So what I find is the variance is $772,100 square, okay? Question C, if the US firm hedges against this exposure using the forward contract, what is the variance of the dollar value of the hedge position? Okay. So if you choose to hedge this exposure completely using the forward contract, so this is the total variance. This is the variance attributable to exchange rate movement. Okay, so total and then exchange rate variance. So if you choose to hedge your exchange rate risk, that means you basically eliminate the variance that is due to exchange rate risk, okay? So you eliminate this part from the total variance, which means that your variance in this case, so the variance of the hedge portfolio, is going to be this part over here, right? So it's going to be the difference between the total variance and the variance attributable to exchange rate movement. Sorry, my writing is bad. This is from the mouse. Okay. So the total variance is what we computed in question B, right? So this is what we computed before. And the variance from exchange rate movement is what we did in problem 1, right? So the formula to compute this here is beta square times variance of S. Okay. So knowing the total variance and knowing how to compute the variance from exchange rates, we can then compute the variance of the hedge portfolio. Okay. Let me see if we have to rush through. No, we still have time. So I'll give you guys 1 to 2 minutes to work through part C. Okay. Okay, so if we are ready, I want to talk about questions B and C. Okay. So if I use the same spreadsheet as before, when I computed the beta coefficient, then for question, so I'm just going to write A here, B here, and C here. So for question B, I'm calculating the variance of P, right? The total variance of our position. Using the formula that we wrote down on the slide before. So probability 1 times P1 minus P bar square, so on and so forth. So for each of the states, right? So for each of the states here, I'm going to compute probability times P minus P bar square. Okay. So I take the probability, I times P minus P bar square. And then finally, to compute the variance of P, I just simply sum all of these up. The variance that is due to exchange rate risk is given by beta square times variance S. So here I've got the beta from question A, right? So this is the beta, and I'm going to square it, and I'm going to times it with the variance of S, which is what I computed from A as well. So the variance of the hedge position is simply just the difference between the total variance and the variance due to the exchange rate risk. So in this case, I'm taking these two numbers and minus each other, okay? So what I find here is the variance of the hedge position becomes very small afterwards, okay? So after hedging, the variance is quite small. Okay. So yeah, so I find that this kind of question is not very complex. It's quite straightforward what the question is asking for. It's just that the calculation takes a bit of time. So going back to Neki's question before, so the reason why we want to compute this beta number is, as you can see, when you hedge the portfolio by this size, by the size of the beta coefficient, you basically eliminate most of the exchange rate risk, okay? So if you change it to a different number, you will find that the variance will be a little bit higher. So this seems to be the optimal number for hedging. All right. We've got 40 minutes, so we still have a lot of time. And this is our last question, so that's good. So in this question, similar to before, the first part will be similar, where you compute the beta coefficient, right? So in this case, what you've got is that you're a UK citizen, so you're a UK venture capitalist, and you invest in Silicon Valley, okay? So your home country is the UK, and your foreign country is the US. So in this case, you invest in your American equities, and you think that in the future there could be two possible scenarios. Okay, a boom and a downturn. So in the boom time, your asset value is going to be worth 1 million USD. The exchange rate is going to be $1.4 per pound. In the second scenario, when the American economy has a recession, then your asset value is going to be only 500,000, and the exchange rate is going to be $1.6 per pound. You also estimate that there is a 70% of a boom and 30% of a downturn, of a recession. Okay. Question A, straightforward. Estimate your exposure to exchange rate risk. In other words, compute the beta coefficient. Question B, compute the variance of the pound value, blah, blah, that is attributable to the exchange rate uncertainty. This is what we have done before as well. Okay. The key question I want to stress here is question C. So in question C, there is a part that we haven't done before. Okay. So in this question, if I want to summarize the information, it's going to be similar to before, except that it is a little bit tricky here with the exchange rate. Okay. So in this case, I've got two different possibilities, boom and recession. For the each of the scenarios, this is the probabilities attached to it. These are the foreign asset values, right, for the UK investor. Now, this is a little bit tricky. The exchange rate in the question is the dollar over the pound exchange rate, okay? But what happened is in your original regression, so when we regress the exchange rate against the home value of the asset here in our regression, the S here is the domestic over the foreign exchange rate, okay? Which means that for this particular table, you're going to have to compute the reciprocal of the exchange rate given in the question, okay? So what you want here is you want a domestic over foreign exchange rate. So for the British investor, the domestic currency is the pound and the foreign currency is the USD, okay? So in other words, you have to compute the reciprocal of the exchange rates in the question. Asset value, so this is something you have to compute for this question. So the home asset value is the pound value of the asset. So to compute this number, you take the foreign asset value times the exchange rate, okay? So let's spend about 5 minutes here on question A, solving for the beta coefficient, okay? So for this question, I want you guys to help me with the calculation, okay? Okay, can someone tell me what is S bar in question 3? What is the value of S bar?
0.68751.
Yes, exactly. So 0.68751. I'm just going to say 75. P bar?
593,760.
Yep, exactly. Spot on. So this would be in the pounds. Covariance? And variance. What would be the covariance in this case? While you're doing the calculation, I'm just going to write the formula here. So probability is 1 times P1 with P1 minus P1 times S1 minus S bar plus probability 2 times 312 500 minus P bar, so 593 762 times 0.625 minus 0.6875. Okay, so what would be the covariance here?
7,535.
7,535, spot on. And the variance. Oh, Long, did you send me the answer? Let me open the file. So there's a file on the chat box. So Long has the answer in here. Variance 0.00167. Yep, spot on, Long. So this is 0.00167. And beta is going to be just the covariance divided by the variance. So I've got a little bit of a different answer, maybe because of the rounding, but that should be okay. So here I've got 4511976. Okay, spot on, guys. I'm just gonna write the formula for the variance just to be complete. So here the variance of S is going to be 0.7 times 0.7143 minus 0.67875, sorry, 6875 squared plus 0.625 minus 0.6875 squared. And the answer will be here. Okay, well done, guys. So this is the beta that we've got, right? So if I go back to the question from before, so compute the variance of the par value of your American equity position that is attributable to the exchange rate uncertainty. So in other words, compute the part of the variance that is attributable to exchange rate, okay? So based on what we did before, that will be beta square times variance of S. So this is something we have done before too. Now I'm just going to take beta square times the variance of S. So this is going to be dollar square. Sorry, this is pound square because we are, the home currency is pound.
Can you explain the pounds squared meaning, please? Why is it squared, not just pounds?
That's because it's a variance. So when you look at the formula for the variance, so the variance involves the sum of square, right? So it's 1, let's say. Okay. So, and then you times it by the beta. So beta here is the USD square.
Okay.
Yeah.
Okay,
so this one is R over USD square. Yeah, good question. So the product of these two will be pound square.
Yeah, okay, that makes sense now. Thanks.
So normally we don't really use the variance to measure risk. We'll take the standard deviation of that. So that will be back to normal. Right, so that was question B. Now for question C, it's similar to what we did in question 2, but I just want to show you one extra step, which is to show the outcome of the hedging decision, okay, for each scenario. So question C, how would you hedge this exposure? Someone tell me, how can I hedge this exposure? So I've got a beta of positive.
You hedge the beta value in
yes.
the opposite direction, obviously, with the hedge, which would be 1 sec.
Yeah, that's okay. Take your time. We've got time.
Short, we would
Exactly.
short it.
Spot on. So this is your position. You've got a positive beta, right? So your regression will be upward sloping. So you want to short to offset the effect of exchange rate on your position. So here you will short so that you can achieve something like a flat line, okay? Second question, if you hedge, what is the variance of the hedge portfolio? So variance of H. Actually, can just type on the Excel file. So we mentioned before, this will be the difference between your total portfolio variance and your exchange rate variance, okay? So what you want is you want the difference. I'm sorry, my drawing is not too good. So here, this will be the residual of the total variance and the variance due to exchange rate risk. So to compute the variance of P, so 33,000, right? So here I've got a negative number, which is not really correct. So I've got to check the answer here. But the point is, once again, so if you hedge your exchange rate risk using a forward contract, then your variance of the hedge portfolio, which is the residual variance, should be very small relative to the total variance, okay? But I've got to check the answer here because I've got a negative number. So far, these are the parts that we have done before in the previous question. But what I want to show you is I want to show you an extra part, which is to show the outcome of the hedge portfolio. Okay. So the question here is, suppose I choose to hedge this position by selling the pounds forward. Okay. So in this case, the question is, what would be the outcomes of the hedge position under each of the scenarios? Okay. So we know from before that if we don't hedge the position, if we just leave it there by itself, then for the boom scenario, the value of our position, our asset is going to be 700 something thousand pounds. And for the recession scenario, the value of the asset is going to be 300 something thousand pounds. Okay. So these are the values of the asset if we don't hedge the position, okay? If we just leave it there by itself. Now, what I want to find out is I want to find out the value of our asset if we choose to hedge our position, okay? So in other words, I'm looking at the value of a combined position where I've got the asset itself, and then I've got the short forward contract. Okay. Now, I didn't give you the forward rate before, but let's just suppose that the forward rate is simply just the average of the two rates. So here I chose the forward rate to be S bar, okay, which is the average value that we just computed before. So in our hedge portfolio, as we mentioned before, there are two assets, right? Two different financial assets. We've got our portfolio in the US, and we've got a short forward contract on $4.5 million. So for this short forward position, if I want to compute the payoff function for the forward position, it's going to be F minus ST, right? This is a short position, so the payoff is F minus ST times the amount of the contract. So that will be 4,511,976. Okay. So my my combined position is going to be the sum of the asset value in each of the states and the forward payoff in these states as well. Okay. So for example, if I look at the first possibility, the first state, this is the boom. So in the boom time, the exchange rate is going to be 0.7143. Okay, so SD is going to be 0.7143. So therefore, my hedge position is going to be the sum of the asset value, so 700,000 something pounds, plus the forward payoff. Okay, so F minus SD So in this case, because the forward rate is less than the future, is less than the spot exchange rate, I'm going to make a loss on my forward contract. So here, the total hedge position is going to be about 500 something thousand. Okay. In the second scenario where I have a recession, the exchange rate at that time is going to be 625, sorry, so 0.625. So SD is 0.625. The hedge position is going to be the sum of the asset value at that time plus the forward contract. So in this case, the exchange rate is less than the forward rate. So I'm going to make a gain on the forward contract, okay? So as a result, my total asset value is going to be around 500,000 something as well. So if I compare the variance of the hedged position and the variance of the unhedged position, without doing any calculation, you can see that the hedged position does not vary too much, okay? So the two outcomes are quite close to each other, whereas for the unhedged position, the two outcomes could be very different, okay? So this is the purpose of hedging. You want to reduce variation, okay? Any question with this slide? So I guess it's just similar to before, but we just take one extra step. to show what happens to the hedge position under each of the scenarios. Okay. So this is the kind of calculation that you would expect to see in the exam if this question comes up. So as I mentioned before, relative to the other topics where the questions could be a bit tricky, I think with this topic, the questions are quite straightforward. You know what you're doing. The only complication is a little bit complex to work out. Okay, so the calculations, the formulas could be a bit complex, but otherwise the question is quite straightforward. Okay. All right, so we have finished all the questions for today and we have about 8 minutes left. So did you guys want to ask any questions at all about the assignments or any other concerns, so on and so forth?
Nothing from me.
Okay. What about the other guys?
Yeah, I'm fine, thank you.
Okay. So if there's no other questions, then I'm going to conclude the class. And as usual, if you have any questions, just email me or book a consultation. Okay.
Thank you.
Yeah, sure, thank you.
Thank you. So I'll see you guys next week.
See ya. Have a nice day.
You too.
Cheers.